This little trickle represents your parents' expenses while they're living independently.
And this is their expenses when they go into assisted living.
Okay, maybe that's a little dramatic, but on average, your parents' life savings will drain 6 times faster when they go into a long-term care facility. If your parent ends up needing nursing home care, the government could eventually force you to sell their house to pay for that care. But in this video, I'm going to show you the exact step-by-step legal frameworks that you can use to protect their life savings and keep the house in the family, all while making sure that they are getting the care that they need. And by the way, if you're new here, I'm Ethan Carbo, and I love helping families learn about caregiving. It's what I'm totally passionate about. This channel is designed to give you good information so that you can make good decisions for your family. But I should say up front that I'm not a lawyer, so please use this video for educational purposes only. And with that said, let's jump in. Okay. Many families assume that because their parents paid taxes their whole lives, that Medicare would pay for the nursing home. Unfortunately, that's not the case. Medicare only pays for short-term acute injuries, like a broken hip. They will not pay for long-term care. The only government program that does pay for long-term care is Medicaid. But Medicaid is a means-based system, which means that in most states, you have to have under $2,000 worth of assets in your name to qualify for Medicaid. So if you don't meet that threshold, then what do? Well, most families try a DIY method, and it does not go well.
See, now I've thought of this. I've thought of this exact thing. That's real easy.
Who are you? What are you doing?
Doesn't matter. All you gotta do is have your mom transfer all of her money to your account. That way when the government looks at her account, they won't see anything. She'll qualify for Medicaid easy as can be.
So that's a pretty clever idea. But the government is really serious about getting its money. I mean, have you interacted with the IRS recently? They will make sure that they get what's coming to them. So if you try what he suggests, it will trigger the 5-year look-back rule, and it's devastating. Basically, when your parents apply for Medicaid, the government will look at their financial history and every transaction that they've made in the last 5 years. They will look for any sort of gift or transfers, or if anything was sold for less than it's worth. If they find anything that meets those criteria, then they'll hit you with a penalty. Basically, they'll calculate how long that money could have paid for care, and then you won't be able to qualify for Medicaid for that amount of time.
So if mom can't just hide the money and she can't just give it to me, how do you protect it?
Well, there's a legal trust that can help tremendously, and we'll get to that in just a minute. But first, we have to talk about saving the biggest asset, the house.
What's ISA?
ISA? It's house. You're reading it backwards. For most middle-class families, the majority of their net worth is tied up in one asset, the house. Now, there's a dangerous myth going on out there that if your parents' house is paid off in full, then the government can't touch it. Unfortunately, that's not true. In fact, it's quite the opposite. It's the very first thing that the government will go after to pay for their care. So here's how it actually works. Medicaid will allow your parent to qualify for Medicaid and keep their primary residence. So the house is fine and safe while they're alive. But as soon as the second parent dies, a federal law kicks in called the Medicaid Estate Recovery Program, or MERP, or MERP. No one calls it MERP. Medicaid isn't a gift, it's a loan. Every month that your parent pays that giant nursing home bill, the government is keeping a tab. So as soon as your parent passes away, they're going to try to recover as much of that money as possible. And they do that by forcing you as the child to sell the home to pay them back. But it doesn't have to be this way. There are completely legal and completely proven frameworks that you can use to protect the money and the house. So let's break them down step by step. Step 1 is specifically for married couples. So the most common question that I see about this topic is if dad has to go to a nursing home and he needs to qualify for Medicaid to be able to pay for it, does mom, who's healthy and at home, have to lose all of her assets and go down to that $2,000 threshold in order for dad to qualify? The answer, fortunately, is no. Medicaid has a built-in rule called the spousal impoverishment protection. So the healthy spouse that stays at home is allowed to keep a big chunk of the combined assets. At the time of this recording, it's $160,000. Plus they get to keep the primary residence, a car, and all their personal belongings.
That is a relief. I gotta call mom and tell her the good news. Are you still here? But wait, What if they're single? And what about the rest of the money? And what if they have more than $160,000?
Well, those are actually really good questions. And it brings us to step 2. So, remember how I told you that your parents can't just gift you all of their money at the last minute? Otherwise, they would trigger that 5-year look back. And there'd be all those penalties, and your parents wouldn't be able to qualify for Medicaid for a certain amount of time. Well, the way around that is something called a Medicaid Asset Protection Trust, or MAPT. Think of the Medicaid Asset Protection Trust like a vault. Basically, your parents can put all of their money, all of their life savings, their stocks, their mutual funds, all of it into the vault, and they lock it up. Once the money is in the vault, it's technically not theirs anymore. It's in the name of the trust. So when Medicaid comes looking around to see do they qualify, all they'll see for their net worth is whatever's left outside of the vault. The best part about this kind of trust is that your parents can still benefit from what's inside the trust. So they can't access what's in the trust, but they can still collect things like dividends and interest throughout the rest of their life, and they don't have to worry about it counting against their $2,000 limit. Now, don't get your hopes too high. This is a great tool for a lot of people and a lot of situations, but it does have its downsides. The main one is that it would still trigger that 5-year look back. So in order for your parent to benefit from this trust, they would have to set it up at least 5 years before they need nursing home care. So if they do that, then they could benefit from their assets generating interest and dividends, all while being taken care of by Medicaid, which isn't normal, and your inheritance would be safe from the government. So pretty good. Step 3 is the big one. How do we protect the house from the Medicaid estate recovery program that we were talking about earlier? Well, fortunately, your parents have 2 very powerful weapons here. The first is called the Ladybird Deed. A Ladybird Deed changes how your parents' house is owned. It says that while your parent is alive, they have full control over it. They can live in it, they can rent it, they can sell it, whatever they need to do, it's theirs. But as soon as they pass away, it automatically transfers ownership to you and your siblings.
But won't the government make you sell it anyway, even if it's in your name?
That's a good question. Actually, the government can only force you to sell the house if it goes through probate, and the Ladybird Deed skips this entirely. So, by the time the government comes around looking for its money, your parents' names are nowhere on the deed. It's in your name. So, the house is completely safe. The second weapon that your parents have is a little less used, but it could be really valuable to you depending on your situation. It's called the Caregiver Child Exemption. Here's how it works. Let's say your parent needs care, so you move in with them to take care of them. If you do that for 2 years and can prove that the care that you were giving them was keeping them out of a nursing home, the government will give you a reward. The reward is that your parent can transfer the deed of their house to you as the caregiver penalty-free. So that 5-year look-back thing where this kind of gift would totally disqualify your parents for a long, long time from qualifying for Medicaid, well, that wouldn't apply anymore. So if that's something that you were going to be doing for your parent anyway, this could be a good strategy. But again, it has to be for 2 years, and it has to be able to be proven that the care that you were giving was keeping them out of a nursing home.
But what if mom needs a nursing home next month? I don't have 5 years. Is it too late?
No, it's actually not. If your family is completely out of time, you can still save a big chunk of your parents' assets through something called a Medicaid compliant annuity. Medicaid won't allow your parents to qualify if they have a big lump of cash, but it doesn't mind monthly income. An annuity is just a legal contract that takes your parents' excess cash and turns it into a guaranteed monthly paycheck from an insurance company. So, by taking that excess cash and turning it into a revenue stream, it won't count towards that $2,000 Medicaid limit. If you have one healthy parent at home, this can be a great fix. You buy the annuity, the healthy parent gets to live off the monthly income, and the sick parent who's going to the nursing home is already qualified for Medicaid because the assets have been turned into a revenue stream. But what if you only have one parent left? What do? Well, that's where the half a loaf trick comes in. Basically, what you would do is you'd take your parents' money and you'd split it in half. You would take half and you would transfer it directly to yourself. Now, this would trigger the 5-year look back, and your parent wouldn't be able to qualify for Medicaid for some time. But that's okay. That's where the trick comes in. With that second half of your parents' money, you would use it to buy a short-term annuity. And you'd use those guaranteed monthly payments to pay for the nursing home while your parent is under that penalty period. You'd try to time it so that as soon as the annuity ran out, the penalty would expire, Medicaid would step in and start paying for your parent. By doing this, you basically use half of your parents' money to save the other half. Now, the money is in your name, so you can use it to pay for things that Medicaid won't pay for, like a room upgrade or better care, and then whatever's left would be your inheritance. This is called the half a loaf trick because half a loaf of bread is better than no bread at all.
I couldn't agree more. Where did you even get that?
This is really dense legal stuff that we've gone over today. The rules that we covered are complex and can vary from state to state. So you really don't want to try to implement any of these strategies on your own. I really recommend that you get in touch with an elder lawyer near you. So I've put in the description a link to a nonprofit that will help you get in touch with an elder lawyer in your area. And it's free. It's a great resource. I'm not getting any sort of commission. I'm not getting paid by them in any way. I just want to make sure that you get the help that you need. A good elder lawyer can save way more money than they cost, so at least check it out. If you found this video useful, please give the video a like, and do me a favor, think of someone in your life who might find this useful as well. Please share this video with them. It really helps out them, and it really helps out the channel. And if you want to learn more about caregiving, click this next video. I'm Ethan Carbo, and I'll see you there.